It's exciting to be back for another fiduciary update for the month. Hi, Allison.
Hi, Will.
How's your summer been?
It's been great.
Allison, for the viewers who may or may not know Allison, she bought a new house.
Oh, I don't know if we want to talk about that.
Yeah, tell them you bought a new house in Michigan.
Yes, I bought a lake house.
Nice. I have not been invited there yet, but
well, I haven't finished buying it yet.
no, she's in the process. So anyway, so this month we've got a lot going on. It's been another surprisingly busy summer month in the terms of the retirement landscape. So for some of the quick hits this month, there's just some recent retirement policies that were announced. Why don't you give the viewers an update on what happened there?
Yeah, so draft of the budget reconciliation bill for this year was released and included two somewhat surprising, pretty expansive retirement policies. First, a requirement for most small businesses to sponsor a plan. Or most employers, I should say. Most employers do sponsor a plan, but small businesses in particular would be hit here. Today it's not required to offer any retirement benefits, so that's a big change. And then secondly, a requirement for automatic enrollment plans to include some kind of lifetime income investment option in the plan. That's a huge change. Those investment options don't even really exist today, right. Let alone a requirement to offer them.
That'd be a pretty significant burden for small sponsors or small companies, correct?
Correct, and that's a big reason why it's probably not going to happen. This is a draft bill, but the drafts are really interesting to give us some insight into, what is Congress thinking, what are legislators thinking, and both of these provisions really moving the ball down the field in a way that we just haven't seen before.
And where's the big push for retirement income inclusion coming from?
This one seems to be, I've seen quoted, a desire to make sure people don't outlive their savings. So that, to me, says the insurance industry is probably pushing for this one. As we think about risks for folks as they save and prepare for retirement, absolutely outliving savings is a big one, but just accumulating enough savings for retirement is also a big risk. And expanding coverage of retirement plans is certainly trying to address that risk.
Yeah. Interesting. Wait to see what happens there. On the cybersecurity front, the Department of Labor has been very active. What's the recent events there?
We're getting more and more reports that the Department of Labor has started inquiring with sponsors about what they're doing around cybersecurity for their retirement plans. It's only been a couple months since the Department of Labor's guidance around monitoring and evaluating cybersecurity has come out. That was the first time the Department of Labor really outlined, hey, record keepers, here's what we think you should be doing. Sponsors, here's what we think you should be doing. I haven't seen it termed an audit yet. Audit's kind of a scary word to say the Department of Labor is auditing, but seeing it termed inquiring, asking questions, what are you doing? How are you using the guidance? So it'll be interesting to see how that unfolds, but just really emphasizing that it's important that committees, fiduciaries are having conversations about cybersecurity, whether they're reviewing it themselves or they're tasking someone to review it and report back so that there's documentation if and when the Department of Labor comes knocking.
Great. GAO report on recent one on participants not understanding fees.
Yeah,
not a shocker, right?
Yeah, so the Government Accountability Office just released a new report. And again, probably not a surprise. Most participants don't understand retirement plan fees. Most participants still don't acknowledge or realize that they pay fees. I believe the number is right around 40% of participants said they didn't think they paid any fees at all. I'm sure for many that's a somewhat disappointing outcome. It's been about 10 years now almost since the Department of Labor required that participants be provided with a fee disclosure. The Government Accountability Office, of course, looking at what should be tweaked and changed. They had some recommendations for the Department of Labor. I think one of the interesting findings, again, probably not a surprise, participants don't understand expense ratios. They don't understand how to correlate. Here's a percentage of assets, and this is what this really means to my account balance. This is what it means that I'm actually paying. Interesting, a point that I pulled out that wasn't really a headline. 60% of the participants said they wanted to see their expenses as a dollar and percent figure. So they weren't saying just tell me the dollars. They were saying show it to me both ways.
Yeah. Yeah, it's we've had a lot of experience in both those angles, and people really can latch on to dollars. It's more
Absolutely.
meaningful versus a percentage.
You know, the requirement for the DOL disclosure is to show dollars per $1,000 invested. That's a little hard to say, well, okay, you know, the disclosure doesn't actually show you how much you have invested in the fund, so you got to go find more information. Another interesting part I thought about this GAO report is they actually looked at a whole bunch of different countries and how they disclose and report fees to participants, and so they had a couple recommendations there, one of which maybe should be fairly straightforward, is including some kind of fee benchmark. Give people context. You know, what does this fee mean? You know, today the only context on the page is here's the other investment options in the plan. So,
Right.
you know, that can lead people to, oh, well, this one's the cheapest. And the suggestion of a benchmark, although a fairly general suggestion, was an average fee for comparable funds. So
Yeah.
we're going to talk about average fees a little bit later on, and that can mean different things to different people.
It's a slippery slope.
Context is important.
Right, absolutely. A recent research report on how participants select investments.
Yeah, so this one was an interesting study. Morningstar did this study, a fairly robust study, albeit a fairly simple study. They had two different groups of participants. They had some controlled groups, and then gave participants kind of slightly different data sets to look at, you know, how impactful were certain factors when participants were building a portfolio. Specifically, they were setting out to study if or how providing information about ESG factors, either ESG factors for the investment strategy or for the fund management firm, might impact participant investment selections. And the finding was that it did, that, you know, all else equal, participants would allocate more to an ESG fund. It was a fairly simple study, and I'll say from my review, one of the big flaws, participants were able to allocate to an ESG fund, all else equal. They could do that without reducing the return, without increasing the fees, you know, materially. So I think, of course, on the margin, you know, that makes some sense.
Yeah, interesting. Our survey of the month is what drives fiduciary liability?
Yes, I'm sure most plan sponsors, a lot of our clients have certainly seen two notable trends with fiduciary liability insurance. One, the cost is going up. And two, insurance brokers want a lot more information in order to price those policies.
Yeah, it's been increasing for years. What are the factors that are driving the increase in costs?
The litigation.
Litigation.
Absolutely. You know, we are seeing, everyone I think is seeing, you know, the significant onslaught of fiduciary breach claims being brought, and, you know, fiduciary insurance providers are certainly taking note of that.
And we've seen a lot of claims being brought, but we haven't seen a lot of awards being.
Well, you know, fiduciary liability insurance, I think, is often misunderstood. You know, this is insurance that protects the plan fiduciaries. So this is the policy you would fall back on if you were facing a fiduciary breach claim and you had to pay to defend that claim, because it's not cheap.
Right. And do most policies cover the claims once the claims are made? But there's a lot of things that go into prepping to sort of prepare to defend a claim that's not covered, correct?
Depends on the policy, yeah. And one message I think we would have to sponsors is, you know, first of all, make sure you're providing your insurance broker with the right information about your plan and your processes. But secondly, you know, it's a good opportunity to take a step back and really look at what does your policy cover. And what doesn't it cover, and have some conversation about, you know, should we consider a change? It's not necessarily the dollar amount of the coverage. I think that's what most people think about intuitively, but to your point, it's the types of instances where that coverage is going to kick in.
Okay. So tell us, Aon did this survey. So tell us a little bit about who they reached out to and what the survey focused
so Aon did this survey. They talked to 12 insurance carriers that write these policies, and they asked them a little bit about some of the different factors in their opinion. You know, what impacts the cost of the coverage? You know, how are they assessing how much liability exists for any given plan? So interesting to pull out factors that did and didn't make a difference. You know, what makes a difference? Fees, and fees. We're seeing a lot of questions raised about fees. What are the expense ratios? Is there revenue sharing? But process as well, which is great to see because fiduciaries are held to their process. So do you have a process to assess your record keeping fees? When did you last do that? Those are questions being asked regularly.
And what about on the advisor side?
Yeah, so that's an area that it seems like brokers are still kind of assessing. Interesting comment that came out was it's pretty much table stakes at this point. The expectation is that any kind of medium to large plus sized retirement plan sponsor is going to have an advisor. And I've seen in some of these questionnaires, if there's not it's prompting, who is your advisor? But if you don't have an advisor, tell us why you don't have an advisor. Tell us about why you have so much expertise internally that you don't need an advisor. An interesting area that it looks like the marketplace hasn't figured out yet is handling different types of advisors. And I think absolutely in the future we could see, if your advisor has potential conflicts of interest, you might have a higher premium. Retaining an advisor as a 338 discretionary fiduciary, outsourcing that liability, I think that's absolutely going to translate into lower premiums going forward.
So maybe just explain to the viewers the difference between a 338 and a 321 fiduciary.
Yeah, so a 321 fiduciary is the most common type of fiduciary relationship for defined contribution plans. It's a non-discretionary advisor. Advisor makes recommendations, but the committee retains the decision-making authority and therefore retains the liability for those decisions. There's no defense of, well, my advisor recommended it, so I did it. In a 338 relationship, the advisor is empowered with the discretion to make decisions. So the advisor selects the investment options, the advisor monitors the funds, makes decisions around when to replace funds. And in engaging in that kind of relationship, a committee, plan fiduciaries are outsourcing that liability. You can never get rid of that liability though, and the committee's always going to retain the liability for selecting and monitoring the advisor and probably on the administration fees as well.
Okay, let's turn to the record-keeping administration side of this, and what are the factors that drive the increase potentially in premiums?
Yeah, I think it's all coming from the litigation. Seeing, case after case after case that is assessing fees were not reviewed, fees were not monitored, fees were uncapped. That's another question that's coming up a lot. The fiduciary insurance providers, they want to know what you're paying per participant, and they want to know how that fee is structured. They're recognizing if it's an asset-based fee, when markets are up double digits 3 years in a row, that means record-keeping compensation is also increasing.
Yeah, so company stocks on this list, which is, we haven't heard of a lot of company stock suits, perhaps as much as we used to hear about them, but we still hear about them.
Yep.
And why is that? Why has there been a change there, and how does this impact your insurance?
Yeah, company stock is definitely out there. The suits are still there. Certainly with some of the changes, I'll say they're harder to get a lot of traction on those suits, but I think it's still safe to say, pretty much anytime you hear about a big corporate scandal, like stock drop lawsuits, probably not far to follow. Definitely still a factor driving fiduciary insurance, but seeing providers bifurcate a little bit between a company stock fund with no restrictions, so participants can invest 100% of their balance, versus a company stock fund that's a little bit restricted, limiting the amount that can be invested, limiting contributions in. So there's definitely a differentiation there as far as how the stock is offered. And of course, that's kind of comes back to process as well.
Yeah, and some companies might have an independent fiduciary.
That's true.
Just for the company stock piece, right?
Correct.
Yeah. What about revenue sharing and retail share classes? I mean, it seems like forever ago that's such an old term, but it still exists, right?
Yep.
Yeah.
Yeah, I think people say retail share classes, that can mean different things to different people. But, the idea of, is there revenue sharing in the plan? What's happening to that revenue sharing? How is that reviewed and monitored? It's unfortunately, it's easy for fiduciary insurance providers to just look at a plan and say, oh, revenue sharing, that's a risk factor, increase the premium. We know, revenue sharing is not inherently imprudent. There's a lot of good reasons to have revenue sharing in the plan. There's a lot of different ways it can be used. So that may be a future kind of iteration of some of this development, and how they're pricing these premiums is continuing to get more and more nuanced there.
What about some of these other smaller factors, specifically like ESG and self-directed brokerage?
Yeah, so also, notable, what didn't really move the needle, not seeing a lot of perceived risk in offering an ESG fund, not, insurance brokers not perceiving fiduciary risk in a self-directed brokerage window. It's pretty consistent what we've seen on the regulatory side. We just haven't seen a lot of challenges to those things. So that can certainly shift if all of a sudden we see, a bunch of challenges going after brokerage windows and socially responsible funds. I thought the one about participating in fiduciary training was interesting. Just didn't really matter to insurance providers one way or another. So unfortunately, doing fiduciary training, not a way to reduce your insurance premiums, but certainly is still good fiduciary process and protection.
Yeah. So maybe what are the biggest risks a sponsor should be thinking about in terms of, boy, I better make sure I'm doing these things perfectly in order to avoid a suit?
I think the biggest one has got to be the record keeping fees. And it's not just that you personally feel good about your record keeping fees, it's can you prove it? What is your process, and can you demonstrate that you've executed that process? It's a prudent process, and you've got real evidence that your fees are fair and reasonable compared to the market.
So this month, we're going to take a deeper dive on just the investment expense discussion, because it's a pretty important discussion. And we often find that people just don't understand. And, it's not an overly complicated area, but there's a lot of jargon, there's a lot of confusion, and just the math is just sometimes hard for people to really put their hands around, right?
And a lot of very sensational headlines and a lot of fiduciary breach claims.
Yes. So the big sensational headline that came out just last week, I believe, was?
So Morningstar released their annual study of investment expenses, and huge decline in amounts paid by investors. $6.2 billion saved. So they're getting that number and essentially saying, this big drop, 44 basis points to 41 basis points year over year change. This is looking at the entire universe of investment products, mutual funds and ETFs, on a weighted average basis. And so they're taking these numbers, this is a weighted average, applying it to the whole universe, $6.2 billion in savings.
Yes.
Looks like a big number.
Yes, it sure
the
does.
way we've illustrated it here, the way a lot of folks would show it.
Yeah, fees going down is usually a good thing. But like any good narrative or sensational headline, you have to really understand what's happening underneath here. And one of the first things maybe we can start with is we're going to talk about weighted average expense ratios, but what is an expense ratio?
Yeah, what even is an expense ratio? Yeah. So I think one of the most misunderstood parts of expense ratios, an expense ratio is not a rate that an investor pays. It is a measure of fees that have been paid. It is a specific, really very highly regulated reporting metric, and there's actually 4 different kinds of expense ratios depending on how you're reporting and when you're reporting. So it's either going to be an annual report expense ratio, here's all of the fees that were paid last year as a percentage of the assets, or it's going to be a prospectus expense ratio that's going to be here's all the fees we expect to pay in the next year as a percentage of expected assets. So again, both of these are measures that are estimates. They are not hard and fast numbers, and they can and they do change over time. If an expense ratio is 45 basis points, that does not mean you are paying exactly 45 basis points.
Right, and for more well-established funds, the numbers don't change as much, but for newer funds, they can change quite dramatically year to year. So, so let's just sort of, before we get into this study more, let's sort of talk about the difference between expenses and asset classes, or just like broad asset classes like fixed income and equities.
Yeah, as we talk about why do I care if the weighted average expense ratio of all funds is 41 basis points, I would argue that is a number that means nothing to anybody unless you really do care about the aggregate dollars paid by all investors to all asset managers, and I just don't know why you would care about that. But there's so much under the surface here, and you hit the nail on the head. First of all is asset class. I think we've got an illustration here of differences by asset class, so you can see kind of side by side, year to year numbers, seeing some shifts and changes across pretty much all asset classes. These are active funds specifically, but look at the range. You know, you can't take a fixed income investment and compare it to an alternative investment and compare it to a U.S. equity investment.
Right.
There are different cost factors that drive the actual cost to operate these strategies in different marketplaces. So, you know, an overall expense ratio for a category even, you know, within some of these categories, you can see some pretty big differences across types of strategies.
And so these are active funds. So these are actively managed funds versus passively managed funds.
Yep.
And so in an asset class like, let's take U.S. equity, you have large cap, you have small cap,
Exactly.
you have mid cap, you have growth, you have value. So you have a lot of different styles of investing in there, which all have different cost structures to deliver those results. So just talk a little bit about...
You've got big firms, you've got small firms, you've got big funds, you've got small funds.
Right.
You know, expense ratios, you know, this is not saying if we say a fund has a 45 basis point expense ratio, that's the all-in cost to the investor. We're not saying we're paying the manager of the Fidelity Contra Fund 45 basis points. I mean, yeah, he's getting paid out of that.
Right.
But also there's cost to operate the fund. You know, they have overhead, they have legal and regulatory expenses. You know, it's the cost to the investor.
Right. So one of the troubling things here is when you look at like a U.S. equity and you see 66 basis points, you're thinking that every fund that's above that's bad and every fund that's below that's good. And that's sort of not true, right?
No, absolutely not. You know, we are talking here very specifically about weighted averages. That's what Morningstar is primarily reporting in their study. And, you know, they cite some reasons why they report weighted averages. At the end of the day, it's all about, you know, what does this information really mean to you as an investor? And in that respect, weighted averages can be a pretty flawed metric because at the end of the day, what do I want to know as an investor? I want to know, how does the cost of my investment compare to the opportunity set? And the opportunity set is not 66 basis points.
So let's move on to sort of the pitfalls of equal weight versus asset weight, and what really matters, because if we're talking about a defined contribution plan lineup,
Right.
you've got a lot of choices in that lineup. You have passive funds, you have active funds, you have pre-mixed portfolios, et cetera. So participant can blend up their own, have their own unique cost, right?
Absolutely.
So looking at the averages can be deceiving at times because we know from behavior that most of the allocations for do-it-yourselfers are very lumpy.
Absolutely. And so let's talk a little bit about asset weighted versus equal weighted. You know, asset weighted is the most common way that expense ratios for a plan in aggregate are reported. So threw together a super simple example here, looking at 5 U.S. equity funds. The first 2 are index funds, much lower expense ratios. The next 3 are actively managed funds, bigger range of expense ratios. So it would be equally correct to report the total expense of this plan on an asset weighted basis, 15 basis points, or on an equal weighted basis. You know, simple average of these 5 fund expense ratios is 24 basis points. That lends you to 2 very different conclusions and shows you some of the noise in an asset weighted reported number versus an equal weighted number. Because if I'm a participant, that asset weighted number at 15 basis points, that doesn't tell me anything. All that tells me is if I built a portfolio with an asset allocation the same as the plan asset allocation, it would cost 15 basis points. But personally, I could build a portfolio that costs 4 basis points by only investing in the Vanguard index. I could build a portfolio that costs 45 basis points by investing in one of the Fidelity funds. Doesn't tell me anything about my opportunity set.
Right. And this is the basis for a lot of lawsuits, right?
Absolutely.
Yeah.
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 And as we expand that, you know, we'll throw up some data here and show, you know, by asset class, these numbers can be really, really dramatic. So we're showing here equal weight versus asset weight for active funds and passive funds. No surprise, in every instance, the equal weight number is going to be higher.
Right.
You know, that just has to do with asset allocation. Like, it is factually true. More assets have migrated into index funds. Does that make it correct, though, to report that on an asset-weighted basis? Again, it doesn't really tell me about my opportunity set.
Right. And it's probably one of the big underlying reasons for the shift from 44 basis points to 41 basis points.
That is definitely one of the factors, but let's talk about some of the other factors as well. I mean, it's oftentimes a misnomer. It's reported as fund managers' fees are going down. Just because that asset weighted number went down doesn't actually mean that anyone changed their expense ratio.
Right.
Now, I will fully acknowledge, yes, some fund managers have been reducing their expense ratios. That's a factor. The number one factor, though, is moves to index funds. Second biggest factor, plans and investors eliminating revenue sharing. That also doesn't mean people at the end of the day are paying less.
Right.
It just means they're paying differently. Whether that's an individual investor who's contracting directly with an advisor and, moving into no, revenue sharing share classes, whether that's a plan that's doing a similar type of approach. But that's noise. And, we didn't even promote the sensational headlines about how these numbers have come down from 90 basis points in the last 10 years. But so much of that is revenue sharing.
Right. Very good observation here. So let's talk about how this would look at a plan level. We got an illustration here for that.
Yeah, so, how do you assess the total fees of a plan if you're a sponsor, if you're a participant? How do you assess is a plan cheap or expensive? And want to offer a couple of perspectives here. So we're showing here 2 sample plans, similar size plans, similar core menus, different target date fund series. Very different weighted average returns. So if you pick that weighted average, you're going to be like, wow, that plan A, that is an expensive plan. It costs almost twice as much as plan B. Plan B come in at 23 basis points on the surface. That seems pretty good, which, by the way, I'll say, 43 basis points just so happens to be about right in line with that total average. But on the surface, you look at this and say, wow, just based on that weighted average, plan A, way more expensive than plan B. We're also showing you here range of returns or range of expense ratios, because remember, this is a plan lineup. It's an opportunity set for participants. And what you'll notice is in both of these plans, participants basically have the same opportunity set. But because of some of those factors that bias the weighted average number, we've got some differences under the surface. So we can show you those in a little bit more detail. First, let's talk about that overall average number. It's bigger, always, almost always. The overall average is going to be bigger than the weighted average. So again, also not suggesting that's a great measure, quite frankly, of expenses. Range of expense ratios is something that I think doesn't get talked about enough, especially across different types of investments. And these 2 plans, they have very different target date fund series. They actually have very similar core menus. They both have index funds. They both have similar index funds, although their participants have chosen to allocate to those funds differently. They both have pretty similar, a lot of overlap in their core menus. You can see that range of expenses in the core menu, pretty similar. Different asset allocations, so that's going to hit that weighted average.
Right.
But the number one driver, let's be honest, for most plans in that weighted average is target date funds. What series you use, and how many assets are allocated there. And here, Plan A has an actively managed series, 43 basis points, no surprise, right in line with that weighted average. Plan B has a passively managed series, 9 basis points.
Right.
That's a huge bias in those overall numbers.
Yeah, and the difference in the index funds, 9 to, I think that says 27% there? 20%
Yep,
there, yeah.
9% of assets versus 20% of assets.
So it's almost double there. So inherently, does this, people would look at this on the surface and say, oh, this Plan A is bad.
Yeah,
right?
Plan A is twice as expensive as Plan B.
Those
Those target date funds are 4 times as expensive.
However, in this particular case, those target date funds have significantly outperformed the index-based target date funds. So how do you factor in, how should a fiduciary think about, if I'm going to offer more expensive funds, performance?
Yeah. Well, look, I mean, the fiduciary responsibility is A, fees are reasonable, not the lowest fees, fees are reasonable for the services provided. So what are the services provided? What's the difference? And investment returns are a pretty good way to measure that difference. Now there's structural factors. You can't just look at returns. Past returns are no guarantee of future performance, but I can tell you there's pretty structural differences between these two, and we think there's some pretty persistent factors, and we can look at what is the impact on returns, and on a net of fee basis, The target date funds in Plan A have generated about 2% more returns on average. I think that's pretty good evidence of value for participants relative to those fees.
Absolutely. But absent that, how does a fiduciary get comfortable with what you said, the reasonableness of 43 versus 23?
So, the approach we take, the 43 number, we don't think it's meaningful. It's the sum of a whole bunch of individual parts. And if you can get comfortable that all of those individual parts are reasonable, then by definition, the whole is reasonable as well. And that includes, each individual expense ratio. How does that compare versus similar investment strategies? There's a lot of different approaches that you can take. We take an approach of looking at a percentile rank versus peers. You can look at a category average. There's a lot of different ways you can assess, is this individual fund expense ratio reasonable? And by making sure those parts are all reasonable, then, the total, doesn't matter.
And so there's a narrative in the industry that has some evidential backing, but the narrative is that all things being equal, lower expense ratio funds outperform higher expense ratio funds. So how would you fit that into this discussion?
All of that research, is important to remember that is giving you information on the margin. When you're looking at an individual manager, it doesn't tell you anything about a specific manager. It only tells you on the margins in aggregate. So it's great, it's good to know, it's great information, but it doesn't account for any one specific fund.
Right. This is really helpful. Let's talk a little bit about fees versus services. You mentioned, what are you getting? You have to be able to sort of understand what you're getting here.
Yeah, so the fiduciary responsibility at the end of the day is fees are reasonable for the services provided, right? So, pulling out for those 2 target date fund series we just looked at in those plans, prior performance, no guarantee of, future results, but here we've got pretty compelling evidence. We can document the differences of the strategy for the target date fund series offered in Plan A. Why is it generating a 2% higher return than the target date fund series in Plan B? I can name about 4 different factors there. And so on a net of fee basis, I would argue the participants in Plan A, they did a lot better, even though they paid 4 times more.
So ironically, would the participants in Plan B have a claim that perhaps?
It's interesting, we've never, I don't think we've ever seen that claim. I've heard the idea of a claim. There are certainly plans out there that only offer index funds and don't offer any actively managed strategies. There are people who approach an investment process and say, I'm only going to consider index-based target date funds. We would argue that's potentially imprudent, that you should be considering all kind of factors here.
Absolutely. Well, you can put us back on full screen then. Is there anything else we want to note from this research? Well, I think the one thing is more to come here. There's a lot more information in terms of fees that is relevant for these discussions. So we're going to tackle record-keeping fees and auditing fees and advisor fees in the future here. So stay tuned for that. And thanks for joining us this month. And thanks to everyone who helped put together these slides. And Allison, we'll see you next month.
Thanks, Will.